Hi, I'm Bill Blain, strategist at Shard Capital. This is actually our second attempt to film this because Kimberly managed to find the slow motion button. I'm not sure you'd have liked to listen to my thoughts in slow motion, let alone normal speed. But let's have a think about where we are. Here we are, it's nearly the end of March 2019, the first quarter. And you know what? The markets are performing far better than we would have expected based on where we were back in January. If you remember, when we all came back from the holidays in January, we had just seen a massive sell-off in US stocks. We had serious concerns about where bond markets were going with the Federal Reserve threatening to tighten. Also, possibility of other central banks following them. In other words, we were looking at a fairly dismal picture. 3 months later, nearly every single global asset class has performed strongly. Very few are in negative territory. Stocks have recovered well. We've seen a number of the corporate names that were really struggling towards the end of last year posting very strong gains. There have been a few disaster stories, and there are a few idiosyncratic stories such as Boeing that we will continue to watch very carefully, but generally global stock markets are on the up. In the bond markets, we were expecting to see a continuation of normalization policies, but instead the Fed has gone all dovish on us, and as a result, bond prices have been rising. The end result, though, rising bond prices, is we are back into negative interest rates in Germany and many other countries getting back close to it again. And we have what looks to be an inversion of the US yield curve, which is typically taken to be a sign of impending recession. Personally, I don't accept that's what's going to happen, but many analysts do, and as a result, if you are to read the opinions of portfolio managers and chief investment officers, they are all now very fearful that we've reached the end of the current business cycle and that we're likely to see a global recession take hold next year. Now that's going to, or even later this year, that's going to be very negative for stocks, and already people are concerned that corporate earnings are under pressure, but is more likely to remain positive for bond markets. The problem is, however, that we have almost zero inflationary pressure in anywhere in the global economy, and deflation is probably as big a threat as inflation at any point. If we take a look at some of the things that are going on, though, within the bond markets, where we were expecting to see emerging markets and high yield under pressure, that simply hasn't happened. They still remain at very tight spreads and low yields, and people have been buying them because they see that as their major chance of making decent returns while bond yields remain so low. Remember, if you're running a pension portfolio, you cannot survive buying gilts or treasuries at sub 3%. You need to find ways to increase the yield. Therefore, people have been going down the credit curve. I'm not convinced that's the right policy. I suspect a better thing to do is to look at alternative off-market investments which aren't going to be so correlated to the negative effects of QE. The negative effects I'm talking about would be the way that cheap money has enabled corporates to lever themselves up and distort the stock market by doing share buybacks. That's just one of the unintended consequences of QE that is so distorting markets today. But what if the outlook for the next 3 months? What have we got to be concerned with? As I said, the first 3 months this year has been generally positive. I suspect that is going to continue as a theme into the second quarter of the year. We still have great uncertainty in terms of geopolitics. What's going on with the China-US trade war, what's going to happen with the US-European trade war, And of course, sitting here in London, we still have no idea what's going to happen with Brexit. We've also got great political uncertainty coming up. Again, here in London, every single day we hear a news story that Theresa May is about to be deposed. I'm willing to take a bet she'll still be there in a year's time. And in Europe, in May, we have elections to the European Community, which I think, the European Parliament, which I think is going to really shock us in terms of the populist votes that we see, where you'll have a strong anti-immigration vote in Germany and a very pro-spending money vote in the rest of Europe. It's going to be very destabilizing, and that's likely to add to some of the fears. But as we've seen through the first quarter, investors are more sanguine than we expect them to be and are refusing to be drawn in to a sell-off just because it's possible things may be bad. I think you're likely to see through the second quarter pretty much a continuation and pushing aside some of the market noise that's going to be hitting on them. If we can take a look maybe just quickly at the tech sector, I think that's increasingly shaping up to be the most interesting market this year. And there are really two ways of looking at it. One are businesses that we think we understand, and the second are the areas where we really don't understand them at all. The first I would characterize as the Apple question. Apple has been a very successful company because they've managed to be at the forefront of every single part of the current technological revolution. They dominated the computing market by turning Apple into an iconic brand. They managed to seize the mobile market by turning the iPhone into the must-have product and again reinforcing their brand. And Apple was pretty much there inventing the third part of the revolution, which was apps. Apple dominates that. Where do they go from here? The talk on the street, of course, is that they're going to announce that they're going to go for services and competing with companies like Netflix to provide content. That is the key word, competition. Apple, can they dominate with their brand and design, where their strength is, in the content? That's a more interesting question. That's where Apple's going to be judged in the future. Personally, I reckon the future is more about things like artificial intelligence, virtual reality, and how you apply these to the ongoing technological revolution. But that's a business that we think we understand because it's doing tangible things. More difficult to predict is the other side of the tech thing, where we have big data. And every single day we still have more headlines about Facebook and Google and all the others and how they use the data that they have been able to suck from the internet on each and every single one of us. Google is in trouble this morning because they've been selling ads for unproven and unworkable dementia cures, because if someone goes in and seeks anything in dementia, suddenly they get barraged with advertising. That is going to be an issue that regulators are eventually going to clamp down on. So how do you value the future cash flows of a company that will be under the regulatory cosh? I suspect that over the next 3 to 6 months we're going to see far more on this and more direction on where the tech sector is going. And since tech has been one of the major drivers of the US recovery, it's something we need to keep an eye on.